Hey everybody, welcome to your week in review for the week of Monday, December 26th, 2022. And oh, what a week it was. Monday was great on the markets. Markets looked great on Monday because they weren't open and we were off work. Happy Hanukkah and Merry Christmas, everybody, which meant that our Monday was on a Tuesday. And some of the best Mondays are on Tuesdays. Unless you can somehow have a Monday on a Wednesday or a Thursday, that seems like a pretty good week too. But at the start of the week, at the start of the day, MBS were down 12 basis points after a long holiday weekend. Even longer when you factor in last week with all the traders phoning it in with very low volume. Start off with news. Our November advanced trade deficit of goods narrowed to $83.3 billion from $98.8, which is a pretty big drop. Imports fell by 7.6% in November to $252 billion from $272 billion in October. Exports fell 3.1% in November. Prices were flat in October, according to the FHFA House Price Index. They increased 9.8% on a year-over-year basis. This is the first 12-month growth rate below 10%. This does not equal depreciation. It just means it's slowing down into normal terms, which could help make housing more affordable for other people. Though those of us with houses, it means you're not making as much money hand over fist. We also got the Case-Shiller Home Price Index, which fell 0.3% in October. The difference between these two is the FHFA is only on conforming loan amounts, so it doesn't take into account cash prices or jumbo loans. So when we factor all of that stuff in, it was down 0.3% in October, and it was up 9.2% on a year-over-year basis. The national composite fell 0.5% for the month, reflecting negative 3% decline since the market peaked in June. With terrible patterns in their 10 and 20 city composites, which stand minus 4.6% below June's peaks. Personal incomes rose 0.3% in November, once again just enough to afford all those minimum monthly payments and all that credit card debt everybody's racking up. Personal consumption rose 0.1%, so at least the consumption isn't going up as fast as the income. Personal consumption expenditures index, which is the Fed's preferred measure of inflation, rose 0.1%, excluding food and energy. It was up 0.2%. At the end of the day, we were down 16 basis points on the day, ending up at 100.53 on the 5.5%, which puts us right below that Fibonacci line at 100.758. We have ever narrowing bands here with multiple pieces of information and multiple data lines converging upon each other. We have the 50-day moving average, we have the 25-day moving average, we have the 100-day moving average, and two Fibonacci lines creating a very tight range. So hopefully there won't be as much volatility. We also got a post from our sponsor at WellThatMakesSense.com, Persuasion. Once again, use what's already and then persuade them. So use things that your customers already predisposed to believe when you're selling them. So try to align with something that they already believe, something they already think, in order to sell more. And find out more information by going to our sponsor at WellThatMakesSense.com and read the full post. And Wednesday was a quiet day in terms of news, but it was a down day for the market. UMBS 5.5 were down 11 basis points early, and the 10-year was down 3. Bonds were moderately weaker to start the overnight session. Some sources cited more easing of COVID restrictions in China as a catalyst, plus holiday mode trading who have low volume still in effect. The still cautious mood is dampening the hopes of a rally in the last week of trading after a brutal year for the financial markets. Global equities have lost a fifth of their value, the largest decline since 2008. Times weren't very good then. And the index of global bonds has slumped 16%. The dollar has surged 7%, and the 10-year yield has jumped to above 3.8% from just 1.5% at the end of 2021. Pending home sales fell 4% in November to the lowest level in 20 years. They are down a whopping 38% year over year. Note that sales tend to lag the mortgage market by a couple of months, so sales today represent rates from October and November. Mortgage rates peaked in mid-November and have been falling since. The spring selling season should see a pickup in sales. Geographically, the West has seen the biggest declines. At the end of the day, the MBS were down 22 basis points, which puts us in at 100.31, which is right in the middle of that very narrowing range where we have a Fibonacci ceiling at 100.758. We have a floor at the 50-day moving average at 100.06, which is narrowing up quite a bit. A lot of support on each of those levels in terms of another Fibonacci line on the floor, and 3 lines being the looks like the 100-day moving average and the 25-day moving average as a ceiling. The Wall Street Journal had an interesting article about non-traded single-family REIT funds, which have outperformed their publicly traded counterparts by a lot this year. Blackstone's BREIT fund has reported a net gain of 8.5%, which is really good compared to the numbers we talked about just a second ago. About half of the assets in these private REITs are residential compared to the stock price of Invitation Homes, the single-family rental REIT, which is down 34% so far this year. The outperformance means a lot of fast money into these funds want to ring the register and pull money out. Blackstone has been forced to freeze redemptions, as has Starwood. So this is a very interesting thing, because if these funds are similar to American Homes for Rent or Invitation, which have a heavy exposure to Southern California and Phoenix, which is where iBuyers like Zillow and Redfin have been slammed, the year-end redemptions could mean forced selling of these funds. We also got a post from our sponsor at www.WellThatMakesSense.com. This is one of the last posts from that great book, Persuasion, which is all about setting up the environment to sell before you actually start selling. So this is all about mechanics of persuasion, the causes, the constraints, and the corrective of behavior, and how you can manipulate those to sell more products. On Thursday, the 29th, the bond market broke its streak of negative opens by being up a whole 5 basis points early. Yay! Though it did rally 8 basis points while I was writing my morning post. Bonds began the overnight session in slightly stronger territory and made some headway around 3 a.m. Eastern Time on global concerns over China's COVID surge. Yields bounced higher in European trading, but found support heading into domestic hours. Yields blipped higher for a few seconds following jobless claims data, which now came back down quickly. Jobless claims came in up 9,000 to 225,000 versus a 225,000 estimate. So it is right on estimate, though. The jobs are holding strong despite all the Fed moves. Continuing claims were up 41,000 to 1.71 million as 1.67 million previously. Seeing investors rotate into defensive names such as utilities and consumer non-discretionary stocks ahead of an expected recession in 2023. The bright side is that the next phase will be early stage cyclicals, which include financials and home builders. 2023 will start out as downright awful for housing. However, the second half could be brighter, especially if we finally see a pickup in home building. Come on, home builders, stop being so pessimistic. Like I said, started the day up small. At the end of the day, we're up 30 basis points on the day, which was welcome. After climbing 2% per month in spring and summer of 2022 and 1.5% per month in spring and summer 2022, in September of 2022, month-over-month rent began falling. Since 10 of 22, all major rent indices have shown month-over-month rents falling, with the declines increasing and by well more than seasonal norms. In November of 2022, national rents declined by about 0.66%. In a preview of coming attractions in December of 2022, rents will turn negative in Phoenix and Las Vegas. That was from econ70.com, and it was dense with information. I had trouble saying it. Which just brings us into the last trading day of the year, December 30th, 2022. Modest selling all night in Europe and Asia as the Bank of Japan unveiled an unprecedented third day of unscheduled bond purchases. This accelerated at 8 a.m. Eastern Time. Not sure what or why or something happened to accelerate things. Probably just somebody with a lot of money woke up and had an opinion. President Biden did sign a brand new $1.7 trillion spending bill last night, so that's going to put a lot of money and a lot of more bonds into the marketplace, as Barry B pointed out. So the government has spent the entire year lamenting inflation, doing all these Fed hikes, that on the last day they're going to pump $1.7 trillion into the economy. Oh yeah, that'll help inflation. MBS were down 16 basis points on the open. U.S. equity futures declined in the final trading day of 2022 as financial markets close out the worst year in more than a decade for global equities and bonds. The index has lost a third of its value this year as tech stocks emerge as some of the most vulnerable to rising rates. We also today got the Chicago PMI, which came in at 44.9 on a 40 average, or on a 40 forecast. It was 37.2 previously. This normally isn't a big market mover, but we don't have a lot of volume, so market moves on easier things, and there just isn't a lot of data, so people need to do things. There's probably some people closing out some positions for the year. The early close trading session at the end of any given year is notoriously volatile. As always, the volatility, good or bad, but today's shaped up to be bad, being down 50 basis points. So at the end of the year, the MBS 5.5 is ending at 100.11. That's 100.11 0.11, which is basically barely above this 50-day moving average, which is the black line, and it's a very narrowing range. You can see a convergence of a whole bunch of ranges. So we have if we look to the most extremes, it's 99.845 to 101.037. So the technicals are really converging on themselves. The 10-year yield opened this year at 1.628 and never really looked back, running to its peak of 4.226 in October. Now likely to close out in the high threes, so it did close out at 3.88 for the year. Inflation rose year over year from 7% to a record high 9.1 in June, with the Fed implementing 4 75 basis point rate hikes, followed by the last 50 basis point hike earlier this month. Consumers felt the pinch at the pump and grocery bills, with food items rising anywhere from 5% for fresh vegetables to 20% for eggs. So looking into next week and next year, dad joke, we have a market closure on Monday. We got some construction spending on Tuesday, but the real market movers are on Wednesday, which will be the ISM Manufacturing Producing Managers Index, which normally isn't a giant mover, but we saw today that it can move the markets. Then on Thursday, we got jobs. We got ADP and jobless claims, and then on Friday, we get non-farm payrolls and another PMI number. So those will be the days that the market can do some moving. So I hope you have a great weekend and a happy new year. Be safe out there, and if you have some time and you're not hungover, check out our common sources and influences, including our sponsor at WellThatMakesSense.com. Start doing your planning for 2023, because the second week of 2023 we're going to have a series of posts that start with the best method I've seen to date on how to plan your year to get your goals accomplished.